Hi, in this video, I'm going to talk about what is asset turnover ratio. It's a very famous financial ratio used in the financial service industry, and we will try to understand what is it all about. So, what is asset turnover ratio? Well, asset turnover ratio is also known as total asset turnover ratio. It measures the efficiency with which a company uses its assets to produce cells. So it's basically a trade-off between your cells and your assets. Okay, and if you put it into formula, it is nothing but the ratio uh, of net cells to the total average asset of the company. It's as simple as that. And a company with high asset turnover ratio operates more efficiently. So that's how we should interpret this ratio. Um, all right. So if you want to compare the efficiency of different companies, you should compare the asset turnover ratio. Well, this is one of the many other financial ratio we should look at. The formula goes like this. Asset turnover ratio is nothing but net sales divided by the average total assets. I will take an example to understand. And here the net sales, are the amount of revenue generated after deducting sales return, sales discount, and allowance, and these kind of things. This is net sales basically. Average total assets, which is in the denominator, is the average of aggregate assets at year end of the current and preceding fiscal year. It's basically the start of the year and the end of the year, and you see the asset value in those two time periods. Take the average of that, and that's the average total assets, which is here the denominator. And then you basically just divide these two numbers. It's as simple as that. Okay, we'll take an example. So here is a company. This company A reported the beginning total asset of that company at the beginning of the financial year is 199,500 US dollar, and at the end of the financial year, the total asset was 199,203 dollar. And over this period, over this 1 year financial time period, the company has generated sales of 325,300 US dollar with sales return of 15,000 US dollar. And as you know that we need to subtract the sales return from the sales, right? Based on this formula. And all right. So the asset turnover ratio of the company is calculated like this. We have, numerator, you have total sales minus the 15,000 sales return just to get the net sales. Okay. So we have to take out the sales return from that. And in the denominator, you have average asset. So total asset at the beginning of the year and total asset at the end of the year. You take the average of that and divide it by divide it in the use that in the denominator. Okay, so this is how it is: start of the asset, end asset value, and then divide it by 2. That's your average asset value, and that's how you calculate. It comes out to 1.55. It can be less than 1 also. It may not always be greater than 1. Here is a comparison of different companies. And remember one thing, that you cannot compare, companies from completely different industries. That won't make sense, because the way sales happen actually in different sectors vary a lot. Okay, and then it depends whether it's a capital intensive sector or it's a labor intensive sector, differs a lot. So it's good to just compare companies within the same sector. So here we have fast food and telecommunication, and we compare industry like company A and company B, which come from fast food, and for company C and D come from um, telecommunications. But we won't compare company A to company C because they are from totally different sectors, so it won't make sense. So the beginning of the year we have assets, and then ending year assets, average total asset, which is just summing and dividing by 2, and then you have net sales, and then yeah, just divide net sales with average total ratio, and here you have the values. Now again, as I said, you can't compare companies from two completely different sectors. That won't make sense. Make sure that you do that within the sector. How do we interpret? Well, the asset turn over ratio measures the efficiency of the way the company is operating. So it's basically operational efficiency, but also in terms of profitability, not just purely from operational point of view, but also from a profitability point of view. So it's about whether the company is able to generate enough sales given its assets. Um, Again, comparing ratios from different industries won't make sense, um, because it varies a lot, and it heavily sensitive to capital intensiveness. So that's something to be taken into consideration. A high ratio is generally good. It's favorable. It indicates an efficient use of company's assets. So while comparing two companies, the one with higher asset turnover ratio, it's considered to be more efficiently using its own assets. Whereas a low ratio indicates that the company is poorly managing its assets, probably not generating enough sales. But that's not always true, by the way. Huh? It may not work in certain sectors where it takes time in order to generate cells, right? So especially the early, if for example, in a manufacturing company, which takes a couple of years to generate cells and all, but the asset value might, would be very high, but the sales wouldn't be that high, especially in the first few years. So these are some of the extra consideration one needs to make. Is few issues, as I said, you can't compare across sectors. That's problem, and it's heavily sensitive to capital intensiveness. If the inventory level increases, it has also an impact. And as I said, it also depends on how old the company is, how whether it's a new company, it's a mature company, all that also play a role. And especially in new company, it is a bit difficult to calculate or measure the efficiency of a company based on this ratio.